Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Let me lay out a scenario for you. On the one hand, you have the choice to go to a Diljit Dosanjh concert, and on the same day, you have the option to go to Kerala to enjoy the backwaters and everything that entails. If you choose one over the other, you're going to have to sacrifice something, and that is opportunity cost. And that same concept can be used to describe a lot of things in the financial world, particularly when it comes to investing in something over the other. That's what we're focusing on today with a few examples. Join me on this conversation is Kirtan Shah, the Managing Director of Credence Wealth. Thanks so much, Kirtan, for taking the time. I hope that I've laid the context well enough. And I want to focus on a social media post that you did recently where you talked about this concept in relation to an investment in insurance versus mutual funds. Can you give us the context though?
Alex, firstly, thank you so much for having me on the show. It's always a pleasure. Like you rightly said, and you laid it very beautifully to start with what opportunity cost is. And I'm sure that a lot of investors who hear us on this conversation would now realize how before 2020 COVID happened, FD was considered to be a great investment. And it's only after 2020 that a lot of investors have understood how a fixed deposit post taxation does not even beat inflation, and hence a lot of retail investors have started moving investments to the capital markets. That's the prime example of opportunity cost, right? Because to try and avoid the risk that your capital may go down, a lot of investment would go to FD, right? But if you don't move that to the capital markets, you're missing out on the opportunity to be able to create wealth. So this is one example on the financial side versus the example that you gave on the leisure side. I'll come back to the post that we are talking about, Alex. And I think it's very important that the investor community understands this, because a lot of us who typically talk to the investor community, we know for a fact that the investors don't know about this. I'll give you an example. So somebody wrote to me on social media saying that I'm investing in an insurance product in which you invest 2 lakh rupees every year for 12 years. After that, for 5 years, nothing happens. And from the 6th year onwards, the insurance product pays you 1,15,000 each year for another 35 years. And not just this, at maturity post that, the product will pay you 48 lakh rupees more. Now, typically, when you tell this to anybody who's a retail investor and in general, not very financially educated, they will not really understand how good or bad this investment product is in terms of returns that it'll generate. They will only be appealed by how 1,15,000 is going to be received for 35 years. And after that, also a 40 lakh rupees or lump sum payment is to be made out. But if I tell you that if you do a CAGR calculation on this particular investment that I spoke to you of, it is 3.7% XIRR, right? This is as good as what a savings account will pay you over such a long period of investment horizon.
I want to delve into that before we go ahead, because Kirtan, when we talk about 3.7%, and we've also used XIRR, which I think, and I've done a show on this as well to tell people, okay, understand this is what XIRR means, this is what CGR is, this is what point to point is. Why don't you explain it while you're doing it as well? So 3.7%, which calculates the effective rate of return you would have for every installment, accounting for every installment over the course of the investment period, right? So explain that. And 3.7% is minuscule, isn't it?
Oh, absolutely, Alex. I mean, in very simple language, your XIRR or IIR or CAGR, whatever term that you are really using, it is nothing but the compounding return that you've made on your investment. So when I say 3.7% is the IRR or the XIRR, in very simple language, it means that the 100 that you invested in the first year became 103.7, and then you got 3.7 on 103.7, right? And so on and so forth. It's plain simple compounding interest. And like you rightly said, that 3.7 is nothing. And you are talking about an investment which is going to span for 50 years. And it is so complicated that you probably once start investing, you can't even come out of it, because there are 100 of charges that are going to be applied to you, and you would not even be able to calculate whether it makes sense for you to stay invested or come out. And this is exactly what opportunity cost loss means, right? That if you've invested in a particular product which is so long, right? And it does not allow you to get out of the product very easily. You are actually losing out on generational wealth creating opportunity, because versus this, had I even done a small term insurance and invested the rest of the money in PPF, which is probably an apple to apple comparison because PPF is also fixed income and it gives you the same tax advantage, I would have still made easily 6.5, 7% there. Or probably, let's say, if there is somebody who really understands that the product is only going to make 3.5 or 4%, those guys would have not done that and done probably a term insurance or a mutual fund SIP. The output would have been significantly higher. Of course, I understand mutual fund and term insurance is not an apple to apple, but I'm saying that if investors understand opportunity cost and how much are they letting go of, probably they'll be able to make much more prudent decisions. But unfortunately, in the insurance business, they don't talk about XIRR, or it's not even spoken about in any documents which are presented.
Yeah, that's a very important point. And also in this example, we're talking about the product that is being quoted. You're talking about 12 years where you're seeing nothing, right? No, actually, not just 12 years. You're investing for 12 years, 2 lakhs every year, and then you have to see nothing for 5 years after that. So 17 years where you're seeing absolutely not a naya paisa of what you put in. And then after that, you get 1 lakh. So you're signing away quite a few years of not receiving anything. But since you mentioned mutual funds, you've actually got the working of what would happen if you invest for that period, and it comes up to a whopping 21.3 crore rupees. And this is important to note because you've not even assumed a very high rate of interest, or not interest, but return. You've talked about 10%. And I'm not saying that what we've seen over the last several years is a benchmark for what happens going forward. But even if you say that nominal GDP growth, which is economic growth in our country, is expected to be around 10%, and you expect that for a benchmark Nifty 50 investment, if you're putting that 2 lakh rupees every year in the Nifty 50, you can expect 10%. Is that how you worked it out?
Yeah, so I was looking at a very simple situation where I'm saying that there's going to be some tax component to this, and some money will get towards the term insurance cover to make it a match to match product of what we are talking, and hence instead of 12, let me consider 10%. But even if you do this same calculation at 6%, Alex, in the worst case situation, you are still going to receive a maturity of 3.7 crore versus the 48 lakhs that the product is offering to you. Now, if you can manage to generate 6% return, which I don't really think is a big challenge at all, right? After adjusting for everything, you are still 4 or 5 times better off than what the product ends up paying. And that is the opportunity cost that you are paying because you don't know where are you investing.
And more than that, you're talking about 1.15 lakh rupees being paid to you at the start of the 18th year or in the 18th year. You're looking at 1.15 lakh and you're thinking, hey, that's a sizable amount of money today, but effectively in 17 years, that's not going to buy you very much because the money is not appreciated in line with inflation, right? And so what you could buy with that 1.15 per year is probably going to be consumed in max to max, maybe a couple of months, if not more. Would you agree?
Oh, in fact, the math is very simple, Alex. If you look at a 5-6% of inflation also, and you see that your product is paying you 3.5-4% of return, that's a clear loss of 1.5-2% on inflation adjusted basis, right? So your money is only growing on the paper, which you're not even realizing how much it is growing by, but you actually lost money by doing this investment on an inflation adjusted basis. But the problem with unfortunately this product recommendation or selling in general is it is typically sold in the disguise of guaranteed returns and tax free returns, right? And that is what appeals the investor community.
Yeah. So unfortunately, it's a product that is pushed a lot, but a couple of things to bear in mind, therefore, and there is an element of opportunity cost if we're talking about what is the ideal investment, or not. I shouldn't even call it an investment because insurance is not meant to be an investment. It's supposed to be something that takes the risk of something happening to you and shifts it to the insurance company for which you pay a premium, and that in definition is called a term insurance product. For a period of time, you're paying the insurance company to transfer the risk of something happening to you to them. why is this the most important product to look at in the insurance, or the only product to look at in the life insurance space? And is there an element of opportunity cost that comes into play here as well?
So Alex, thank you so much for firstly asking this question, because unfortunately, when I talk to a lot of investors and I tell them that term insurance is actually the only product that you need, the first question that they come up with to tell me is that if I take a policy, I pay premium every year, and if nothing happens to me at the end of the policy, I don't receive anything back. So I always counter to them that, aren't you happy that you are alive? What do you want more money to come to you?
But another example, sorry, Kirtan, just to cut you off here, apologies. I do want to say something, right? You have a beautiful car. It's something that you're very proud of, and they say that you spend more time in your car than you do in other places, so it's effectively your second home, and you have to get motor insurance for that car, right? And if you don't claim it at the end of the year, do you stop and say, hey, what happens to my money? No, you're happy that your beautiful car has not gotten damaged. And that's the same thing for your life, isn't it? If anything, it's more important with your life.
It's just funny, Alex. That's the way all of us look at investing and money in general. But I think you asked a very interesting question, that while term insurance is the best product within the insurance gamut for you to really put your money in term insurance, also there are a lot of other variables that you might want to ignore, right? Because exactly the thing that I spoke to you of, that the investor community is concerned that if nothing happens to me, I don't receive anything back. To solve that problem for the investor community, there are multiple options within the term insurance space also that the insurance companies have come out with. And I really want to use this medium of our conversation to tell the investor community, please don't go for anything else except for plain vanilla term insurance, because there is opportunity cost there also. Let me explain. Let's say I'm 35 years old. I want a policy till 75, let's say for the next 39, 40 years. At my age of 35, a plain vanilla term insurance is available at 22,500 rupees a year as premium for 1 crore of insurance, right? What this product is, every year I pay 22 and a half for 39, 40 years. And if nothing happens to me, nothing is received back, right? But to solve this problem, the insurance company will come up with a product which says premium will be paid back to you if nothing happens to you. So what happens is, if you opt for that product, then your premium from 22 and a half moves to 42 and a half, right? So you are paying 42 and a half each year for another 39, 40 years. And if nothing happens to you, then you are expecting all the monies that you've paid to come back. Now I'll tell you some math. First thing is that they don't pay you the 42,500 entirely back. They will deduct GST. So what you get is roughly 36,000. Now, if you multiply 36,000 by 39, 40 years, you will roughly get 14 and a half lakh rupees back. Now look at this. If I invest the difference, okay, the 22 and a half, which was plain term insurance, and this other product, which is 42 and a half, if I invest the 20,000 of difference, even at 6%, right? My maturity value is going to be roughly 23 and a half, 24 lakhs, which is 10 lakhs more than what the insurance company is paying. Or the other way of looking at it is, when insurance company pays you roughly 14 lakh rupees back, they've ideally paid you only 2.77% returns on that additional 20,000 rupees that you've paid. So I always keep saying that investing is extremely simple. People like us make it extremely difficult, right? In term insurance also, you ideally only want to go for the most simple vanilla product where you receive nothing back if nothing happens to you.
Yeah, because it is not an investment, it is an insurance product. It is a risk shifting from you to the insurance company. Remember that, and it's a cost that you bear in order to ensure that your financial dependents are taken care of. So it's very clear. It's like an automotive insurance policy. You're happy that nothing happens to your car. The same is true for you. But you can stretch that opportunity cost to another a very important conversation, which I think is the talk of the town now, Kirtan, where interest rates have been falling, right? So everybody's talking about either getting a loan or repricing their loan, or bringing the interest cost lower. And again, this is an interesting point that you raised, where you have the option of reducing your EMI or increasing your EMI or increasing your tenure. You say that the tenure is more important, because you can actually invest the surplus. This is also an element of opportunity cost, isn't it?
Oh, 100%. I mean, if I can share the math that we
Please
are
do.
discussing,
Yeah.
that give more clarity to the audience who's watching us. Let's say, and this is an actual data, right, that I'm quoting. Let's say you started a 50 lakh home insurance in 2010. Home loan, sorry, not insurance. You took a 50 lakh loan for a tenor of 15 years. The interest rate at that point in time was roughly 8.45%. That would have taken your EMIs to 49,091 rupee. So if it's a 15-year loan, 180 months into 49,991 will roughly be 88 lakhs 36,000 that you will pay to the bank at the end of the 15-year tenure. So if you've taken a 50 lakh rupee loan and you pay back 88 lakhs, you've typically paid 38 lakhs as interest more, right? Now versus this, if you actually instead of a 15-year loan take a 20-year loan, right? What will happen is because your tenor has gone up, your EMI will come down. So now your EMI instead of 49,000 will become roughly 43,233. And if you invest the difference of 5,857 every month as SIP, mind you, we are not asking anybody to invest new money. We are saying your original EMI was 49, now it's become 43, so you invest the remaining 6. This is not new investment. Now, if you invest this remaining 6,000 rupees, then the math so beautifully works out in your favor because at the end of the 15th year, you paid the bank roughly 78 lakhs, right? Which means you pay 28 lakhs of interest versus 38 lakhs that you had paid in case one that we were discussing. So your interest outflow went lower. What you have to pay to the bank, which is outstanding because it's a 20-year loan and we are talking at the 15th year, is roughly 21 lakhs. But the 6,000 SIP that you did in the last 15 years, actual data point has actually become roughly 33 lakhs. So from that 33 lakhs, even after paying some taxes, if I pay back the 21 lakhs that I owe to the bank and close the loan, I will still have 11 lakh rupees roughly left with me. My loan is also closed. And that is the power of making sure that you are investing correctly and probably the opportunity cost. Of course, here the argument is whether or not what happened in the last 15 years will happen in the future or not. And also whether you will be able to continuously be able to pay the cash flow in terms of EMI or not, and whether you want to be debt free or not. But I'm saying from a mathematical standpoint, if you're a disciplined investor, you have the risk appetite and you're confident on the cash flow, this is a much better way than trying to prepay your home loan because probably the investment that you're doing will end up doing much better over a longer period of time than the rate at which you got the loan.
So, I love the way that you illustrated this, Kirtan, because the numbers do bear out. I just want to ask, when you've talked about this SIP on a monthly basis, 5,857, you've looked at the Nifty total return index. So therefore, the returns would be roughly what, between 12 and 13% over that period, roughly?
Yeah, so it's an actual Nifty 50 PRI number of the SIP started in 2010 up to 2025, and the actual number is 13.91%. That's an actual number for the last 15 years.
Right. Okay. So, and we're not talking about very large figures here. We're simply talking about a 6,000 rupee SIP. And as you said, this is not new money. This is what you might have paid anyway if you were taking a 15-year loan. And effectively, both of those loans are closing in 15 years. So there are a few nuances, though, to this that I want to discuss with you, Kirtan. I'm not finding fault. I'm just discussing possibilities. And these are things that people talk about, right? So when we're talking about a 15-year or a 20-year loan or a home loan, because these are the large loans that we're talking about, effectively what you're saying is that the way that these are constructed is that you're paying your interest at the start, and over the course of the loan period your principal gets repaid, right? And most of the principal payment is concentrated towards the end of it, which is why people say that even if you pay one extra EMI every year, that is going towards principal repayment and you're dramatically reducing your interest cost. Does this improve the odds even on that kind of a calculation?
So I'll give you another interesting data point that might help the viewers understand. Let's say if you've taken a 1 crore rupee loan for the current interest rate that prevails in the market over a 25-year loan. your EMI will roughly turn out to be 80,000 rupees a month, right? Now, in the first year, when you pay the bank 80,000 into 12, which is 9,60,000, close to 8.5 lakhs of 9,60,000 that you are actually paying is going towards interest, right? Now, if let's say you are extremely disciplined and you keep paying this EMI for the next 15 years continuously without missing anything, right? You've still paid back the bank only 35% principal. And in spite of paying your EMIs for 15 years, you still have a 65% principal repayment yet to be done, which is happening in the last 10 years. Another thing that you have to understand, let's say I talk about the last year, 25th year. In 25th year, when you pay 80,000 into 12, which is 9,60,000, the interest on that 9,60,000 is only 50,000 rupees. Now, what am I trying to tell you? In a 25-year home loan period, if you are in the first 15 years, you might as well want to pay as much as you can back to the bank, because that is the time where you are actually paying most of your principal. But if you are in the last 10 years of the 25-year own loan, please understand, when you are returning money, it is not making a lot of difference because your EMI is only paying the principal.
Yes.
The interest that you are paying is very little.
Yes, yes. And that's exactly the point that I was making. So it depends on where you are and here in the context of what we're seeing right now. So assuming, Kirtan, that you took a loan maybe 2 years back or 3 years back, maybe 2 years back. You're in a situation now where the interest cost is significantly lower in the system, and you're within the first 5 years of your repayment cycle. So you have the option of reducing your either reducing your EMI or reducing the tenor. So the question that I have for you in this situation is that between the two, generally they say don't reduce your tenor if at all possible, because your interest cost goes up. But what you're suggesting is that if you reduce your EMI, the amount that you can invest on an ongoing basis goes up, and you can take advantage of that to bolster your saving over a period of time and use that lump sum that you can at some point of time in the next 5, 7, 10 years to knock off a good chunk of your loan. This is effectively the concept that you're talking about, isn't it?
100%, 100%. So there are two things. I mean, to sum this up, either if you are somebody who believes that, I want to live debt free, right? Then my suggestion is that if interest rates are going down, do not try and increase your tenor, right? Keep the tenor same and try and pay the same EMI so that your loan gets done very quickly. So don't reduce your EMI, keep the EMI same so that your tenor reduces, right? But if you're somebody who's going to invest, then definitely this is a great opportunity, like the example that I gave you the last time, that you might just want to increase the tenor, reduce your EMI, and invest the difference, which is going to be far better off at the end of the 15th or the 20th year than just trying to continue to prepay your EMIs.
Okay. And we haven't even talked about incremental increases in earning potential, because this is something, Kirtan, that a lot of people experience when they do take home loans. They stretch a little bit in the first couple of years and then it becomes more comfortable. It's like maybe new shoes that you buy. Once you start using it a little bit, you get more comfortable. I don't know if that's the best example, but effectively you have more money to pay, and so therefore you can contribute more. Rather than prepaying your loan, you say invest more. And I know that it's not a blanket way to approach this, but if you are to invest that surplus or that difference, what is the way to do it? Because people often gravitate to the most risky investments, which is, in this case, you're talking about small caps or you're talking about thematic sectoral funds. Is a simple index strategy the best approach here?
Oh, 100%. I mean, look, the basic funda here is very simple, right? That if you're paying 8.5% on your loans, then you might want to invest it at a place which is going to make you more than 8.5 after taxes, right? So if you're not going to prepay but invest that money in an FD, you might as well prepay. So the only objective way of doing this is, if you're not going to prepay, right, you might as well want to invest this in the equities market. And the best way to go about it is to do a large cap, flexi cap, or an index, unless you are extremely confident that your cash flow is not going to become a problem over a period of time to be able to make the EMI payments, and you can take risk on this investment and want to generate higher returns, right? If that's not the case, so flexi cap or an index or a large cap fund will really solve the problem.
The last question that I had is, we've spoken about mortgages or home loans, but people often go for car loans, 6-year, 7-year, or whatever, 5-year car loans, right? Is this valid on something like that as well, or would you knock off these loans very quickly if you have the option?
See, actually, here what will happen is, because the tenor is so small, the
Yes.
compound is not really kicking, right? So whatever we are trying to discuss, it looks beautiful because it actually has the tenor where the investment gets the opportunity to compound, which may not happen in a car loan.
Yeah, that's a fair point and an important clarification. Kirtan, as always, absolute pleasure having you on the program. Thanks so much for joining in.
Thank you so much for having me.
All right, well, that brings us to the end of this edition of Your Money Matters. It's been an absolute pleasure bringing it to you. Let us know what you think in the comment section and do stay tuned. This is NDTV Profit.